will turn it over to him shortly, but I just want to thank you for taking time out in either watching it live or the replay. We are building a library of these that will be in our Creative Capital YouTube channel, open to anyone. So some of our investments are for accredited investors. This is one of those, but the education is for everybody. So if you're accredited, you probably already have things like this, or even I see some investors are in this. So our friends at US Energy will do an update on the fund that most of you are in, what's going on, what's next, how it's performing, and then as important, the current one. So again, each year you need the income offset, you have to buy the program for that year. So the new year is open. We added US Energy last year to our playbook, and they're in the playbook again today, because that's why we're here today. They're still in the playbook. And the interesting thing with oil and gas, and I'm sure we'll talk about it. There's a lot of fly-by-nights, in general and in the industry, more there than anywhere else. US Energy is a 40-year company. So they're doing something right. We look at that kind of heritage when we're seeing what's going to go in our playbook, because our clients are trusting us and we're trusting them. And so all of our work isn't after the sale, because that's all US Energy doing the work. All of our work is before the sale. Do we trust and do we like and do we want to partner with US Energy? And the answer is yes. We will. We plan to look at every one of their programs. And we like the fact that they have that legacy. We like the fact that their deals are not so big that they never fill up. They're manageable in the space. And I'll turn it over for numbers and all that stuff to the guy that lives it. So I want to thank you for your time. I'm going to turn it over to you. A little bit of an intro, and then a little bit of legacy, performance and outcome, and what's next for anyone invested. Of the current deal, not a reason to do it, but there is an early incentive if we can get paperwork done. And again, I'm not asking for it because it's stressful for both sides, but there is an early incentive. So if you're already talking to one of your strategists here, and this was one of the things you were considering, if you don't mind walking through that. I do know, and I think we both know, that with the changes in the opportunity zone laws, let's spend a little bit of time, 4 or 5 minutes at the end, just what that means. Because I know US Energy also plays in the opportunity zone space. And it's a different way of playing the space. Most places are real estate, development, and this is a different view using the same opportunity zone fund structure. So again, educational. Some of you do this, love these things. Some of you just love to learn. Some of you guys are in real estate and just know what's out there. So this is a non-real estate way of doing an opportunity zone if you already have too much real estate. So that's a bunch of stuff. We want to do it in 15, 20 minutes. We want to keep things short. Just like me, short and sweet. So I'm going to turn it over and let you run the show, my friend. And thank you for being here. Thank you for taking the time.
Thank you for the time. Now, just to double check, my screen shows the visuals. Is that on your side, Fred, or no?
I only see you.
Oh,
I see
right, well,
you.
then I'm gonna bail on that because I'm looking.
If you're considered a visual, then yeah, I see you visually.
I am not. So. Well, here's I think would be a good, what I'll do. And again, my name is Fred Gratz, also along the side, the other Fred today. I'll share with you, Fred, after this. I'll send over the deck that I'm referencing. So for anybody that wants the visual,
yes, please. Yeah, reach out to us. We'll send the deck.
Sure.
That's probably safer for both of us since we're going to put this out there to educate the masses.
Right. Exactly.
And I do like working with another Fred because there's not enough of us out there.
I've met 4 in about 50 years. So yeah, it's pretty crazy. It's an old school name, right? Yeah. So again, thank you everyone. Fred Gratz with US Energy. I run the East Coast for all of our different tax structures and verticals. And we have become, over the last 10 to 15 years, the largest provider of these style of investments in the nation. To the point now, we'll do about $1 billion this year that we'll deploy across various subsets of the energy sector. And there's actually several different styles or ways, right? Most people, when you think of the investable landscape, say in the energy space, some of this you guys already know, and some of it you might not, right? So what you know are the more public facing side, right? What I would call over the counter. Right. So stocks, MLPs, right. The royalty trust market, and when you get into what are called private securities, right, maybe just think of them as institutionally structured. You start to see this whole world open up where you have several different types of funds. They all have different return profiles, different tax mitigation components to it. And that's kind of where we live. And so from our perspective, and I'll try to get to the boring stuff out of the way, right? We've been doing this 46 years. We're privately held. We have, for the vast majority of our legacy, we're the biggest investor in everything we do. So we will own between 20 to 35% of every fund with our own cash. So the chef eats his cooking. And that to us is important in terms of alignment. And it's actually to the point now, and pridefully so. If you look at our financials, you'll see that over 3/4 of our top line income comes from the assets that we've invested in alongside of our partners. So we make all of our money doing what we offer, right? And the way that these are structured, and we're a little unique in that we like to seek out the best economics in terms of what delivers the best tax benefit and return profile to an investor, right? So sometimes that means we operate assets and sometimes we don't. And to be honest with you, for the last probably almost 10 years, the vast majority, 80-90% plus of our portfolios are not operated by us. It's Exxon, Chevron, Oxy, Conoco, Shell, and the list goes on. But we've actually been able to put ourselves in a position where we have been an ideal partner for the majors out there. So we would, in other words, rather use their infrastructure, their acreage, their geology, their scale. It makes our break evens lower. It keeps the economics in check. And it allows us to deliver what our entire 40,000 strong capital base, our investor base, comes to us every year for, which is, yes, tax benefits, but they want us to produce a lot of visibility, repeatable cash flows, right? That's our business, right? We want to deliver consistent singles and doubles. We're not the highest potential returning profile or provider out there. That's not our job. We don't want to find the next basin and prove it out and take that risk. We want to go into we have a lot of offset data, right? So we only do proven developed production, right? You're using thousands and thousands of data sets from neighboring assets, and a very kind of a high density asset perspective where you have a lot of knowledge before you actually operate an asset. This gives us the predictability. It allows us to hedge production. So the point being is that every design, every channel that we operate in, we're looking for almost like manufactured cash flows. We want to have that repeatability. So the downside, right now, the upside there is that you're taking a lot of the major risk sets off the table. But the downside, to be truthful, is we're not looking to take $1 from an investor and promise or tell them we're going to give them $10, $20, $50 back, right? There's nowhere near enough risk in the style of operations we do to come anywhere close to those. All right, so we'll go through all this with you, but I just want to kind of set that stage. So let's kind of jump into the first of a couple of ways people can use these, right? And the first are what are known as drilling funds, right? Drilling funds are it's all part of the tax code. We have a tax workbook that actually looks like this. We'll send that over to Fred's office as well if you guys want to share this with your CPA. So everything I'm about to say, it's all tax law. It's not my interpretation of it. It has all the citations within. So we'll provide that over as well. But the first way that they'll use these are to reduce ordinary income, right? So if Fred on paper is making, say, $500,000 a year, right? Now that's great for Fred, but he's paying a lot of tax. So where these can be a lot of fun is that for every dollar that gets invested, Fred can take a deduction of 85 to 90% or 85 to 90 cents on that dollar as an above the line deduction. So his income goes down, right, by about 90% of what he puts in, right? So it does a really good job. And it's what's fun about drilling funds is that you don't just get a tax write-off on the way in, right? You get a big deduction up front, but you also get tax benefits on the way out. So you're getting portions of your tax, your cash flows that are tax-free in perpetuity. There's all kinds of cool components here. So in other words, big tax write-off on the way in, and then very heavy, very fast cash flows that kick in once the portfolio is online, and you'll get decades of cash flow. But just know it'll be very high early and kind of lower on the long end of that tail. So, Fred, does that make sense? Any more clarity on some of
Yeah,
the?
no, but I tend to say, and I have an MBA, been doing this for 25 years, but I try to simplify it. When you get a nail in your tire, the air comes out faster at the beginning and less at the end. And the commodities under the ground are the same way. So our break even for our clients, we typically say 5 years. It's never taken that long, but obviously we want to be like Scotty in Star Trek and under promise and over deliver. You get the right off the year you did it, as Fred said. You get income along the way once they start, producing. The income will last, and we have some clients that they're third generation getting the income. Now, we're not guaranteeing it's going to last 3 years, 30 years, but they'll run the project, and these are multiple wells, so don't worry about one well being dry. This is a project. You'll get income as a partner for as long as it makes sense to take it out of the ground. What we tell clients is if let's say oil's $1, they're not going to take it out of the ground, but we're not leasing the land. You guys own it. It's still going to be there when oil gets back up. So the income is like a business. We don't know. We hope it'll be growing each year. It'll go up and down. I don't think in our generation, we're going to do away with oil because of all the derivatives of oil. If you look at anything man-made, at some point, oil touches it in 99% of and it might be things you don't even know oil touched. So you really can't shut that down without closing the entire world. And we'll go back to Stone Age, which, everything will be greener, but now we're in the Stone Age. So you did a great job, Fred, of explaining it. I think the questions people have to do with what's the price of oil at what point? And I think most people know enough that at some point, if you're a high cost driller, which, we wouldn't be talking to US Energy if they were the highest cost driller. But if it costs a driller $70 to get out of the ground and oil's at 60, they can't afford. No. So each of your projects have its own, but can you walk a little bit through what's your sweet spot? If oil stays at $60 forever, are you able to make money? Can the investors make money? Because obviously there's a catch-22. The more expensive oil is, the better this investment for all of our clients are. And probably the worse the economy is if oil's so expensive, then so much everything it touches is expensive. So there is a sweet spot where we're making money on the oil and gas side, the economy isn't suffering by $300 a barrel oil, which
that's the tough part, right? Because the only thing that happens when you have crazy high, like super spikes in price, right? Yeah. Do these things get massively profitable? Sure. Right. But is it a regressive tax on the middle and lower class? Absolutely. Right. It breaks the back of their budgets, and it might not change your lifestyles, right, by spending an extra $50 to fill your tank. But that is something that has just oil's an input to everything, to your point. And that is a very strong point. So to answer the question more directly, our break evens are $48.50. That's our break even. Right. So if oil went to $48.50 and stayed there in a vacuum for 10, 20 years, if someone put $1 in, they'll get $1 back out. Right. That's our, again, break even plus tax benefits, but just know that that's the part. And obviously, at 60, it becomes very profitable. Here's what we love. We love this 65, 68, 70. This is the Goldilocks zone. This is that perfect homeostatic price environment that is still quite enormously profitable to what we do and where we operate in the core of the Permian. But it's also low enough to keep capital out of the space, right? There's a saying in the business, the cure for low prices is low prices, right? Because meaning that if 70 became 50, which we've seen that in a can, but if the longer it stays there, the more likely it's going to hit 120, right? That rubber band goes the other way. But we've actually seen a lot of shorter, kind of tighter volatility in the mid 60s, low 70s, which is awesome, right? Because it's still, the margins are still there to get the cash flows that you're looking for. And you're not seeing it prices high enough where all that private equity money kind of comes in and screws it up, right? Drives costs up and everything else. And that is a big kind of part of these. So what's fun about them is that when you're utilizing these, right? So just back to that example, I'll give you one kind of fun example of how investors can use these on the tax planning side. So get back to Fred's example, right, of $500,000 income, right? And we're agnostic what people invest. We do have some minimums on some funds, but for the most part, we want people to get the most bang out of their tax buck, right? So what I mean by that is, if Fred were to put in, say, $60,000 or so, right, as just to make up a number, and maybe it's 70,000 in this case, and his income goes from 500, right, down to 440, 450, right? Well, now what's happening is he not only gets that write-off, but because Fred has business income, he gets something called the QBI deduction, right? At 500K, Fred, you make too much. You don't get the QBI deduction. Sorry, you made too much money, right? But my point is, where these investments are fun, guys, is if you can phase in a phase out, right? So if I can get Fred's income from 500 down to say 420, 430, now he's under the QBI threshold. In English, what this means is now Fred can take another 20% off his federal tax, right? So his income goes down by another 80 or 90 grand again after that. So I made a comment that Fred gets about a 90% write-off, right, on his invested dollar. Well, when you look at where you can kind of catapult one tax benefit to another, right, phase in a phase out, now he's getting a 200% write-off, right, because he's unlocking another benefit that it was previously closed to you. So that's just one example of how these can be, I guess, fun to use on the case planning. And if you're not sure, ask Fred's team about this. If you have business income, right, S corp income, LLC income, just own a business. But there's a lot of cool things that are out there that maybe you haven't had access to because you've done too well, but maybe you can bring them back.
Yep. And we have an accountant that will work with us and we have a worksheet we can give you, and some of you probably have seen it. Basically, it's a one pager. You tell us what you think your income is and what buckets is going to hit in 2025. The accountant then, I think we use a 70% write-off just to be lower cost, for the numbers. And then we ask the clients for two numbers, the minimum you're thinking and the maximum. We're not going to let you do the maximum unless it makes sense. And then you'll have an analysis back. If you do nothing, here's your taxes. If you do the minimum, here's your taxes. What your taxes will be. And if you do the maximum, here's it will. And sometimes the maximum is too much. There's a diminishing return. And so we'll figure out with the investor and their accountant, how to do this. And this is the fun part with accountants. If they're old, meaning in their, let's say, late 60s, they've seen these in the 80s when Fred and I were involved playing G.I. Joe. And not this company, but a lot of them. I mean, the 80s was the wild, wild west. And some of these were dogs. They were buying dry holes, getting the write-off. And then you owned a dry hole that didn't make any money. We're going directly to the U.S. Energy of the world. They're as Fred said, they make most of their money doing the thing we're getting on.
That's a good point. Let's draw a distinct line there, because there's a question I get on the daily, right? Well, what if you drill this hole and it's dry? And a dry hole hasn't been a real risk in 30 years. And that's not a brag, right? No company should ever brag about that. The technology's there. If you know where to operate and you go into areas that have known quantities, that's just how it works, right? If you're thinking about something that has a lot of sides on that die of risk. We look at this as the indexing of the space, right? So we don't want that idiosyncratic risk of a concentrated or risky asset. Instead of that, we'll go into these known areas like the core of the Permian. So 2 years ago, we were so happy we finally moved from tier 2 to tier 1 assets, right? We're drilling directly alongside of where Chevron and Exxon put their own capital, right? And whatnot. Now, in the last 12 months, we've accessed kind of that what's called tier 1 plus, which is the tip of the spear, the most sought after acreage that's out there. And it's because we've been such a longstanding partner, and we can close on 9-figure deals quickly, right? We have the dry powder. It's put us in a unique spot. But the cool part about that is you're getting that ability to have repeatable results. So you're not wondering if I spend, and this, guys, these are expensive. These wells are 12, 13 million bucks each. We're going 12, 14,000 feet down. Your laterals are 2.5 to 3 miles. It's the bleeding edge of the sector. But you're not wondering if you're going to take a loss on that asset. Now, what I can tell you is that well going to produce $2 of cash flow or $3? I don't know, right? It could be $1.50, right? But there's a very tight standard deviation around that rate. So what we're trying to do is just hit a massive bell curve of return profiles through hundreds of assets in one single fund. And that's where that kind of repeatability comes out.
And we're looking for singles and doubles. All of our clients are wealthy before they come here. They're not looking for a flyer, not looking for an audit. In all of our education, you'll never see any solar or wind, because that hasn't been to the tax court. What Fred showed you there was the tax code, but also we know, because some of these things have been to the courts interpreted the law the way the law is, and the U.S. Energies of the world use that to build the fund. Like, all right, this is how you guys think about it. Here's what we're going to do. Whereas before, some people, again, earlier on, people could read the law the way they wanted to read, and then they get taken to court, and then the tax court say, no, here's really what we meant. So that's all been, and because this is from 1942, I've never seen it on the political chopping block of getting rid of this, because not everyone knows about it. Not everyone can use it. Not everyone wants to, not everyone has the issue of too much taxes. And it's, we have clients that are government officials that are using this because they know how it works. So Fred, let's look a little bit about the 24 program, still ramping up. Just catch us up. Sure. And then what's open for 25, and then the opportunity zone. We like to keep these, a half hour ish, just so people can have their lunch and have their lunch with us.
25 is really a retread of what the last 5 to 7 years of what we've done. So all operated by the majors. The funds have gotten a little larger. We'll do $1 billion this year. 600 million of that or so will be inside of the drilling fund. We have some other subsets like op zones and some other structures outside of that as well. And very similar on the tax side. We typically target about an 88 to 90% write-off that first year. That's in play. We have slightly changed our early investor structure. So for those that are looking for one unit, a unit's 100,000, and they can complete that by the end of July. So the downside is only 2 more weeks. But that's there for investors, and we'll give them better terms. Short version to that is you'll make more cash. Your cash flow will be a little bit higher if you come in early. And the reason for that is the single biggest issue facing this sector for the last 30 something years has been, and Fred, you know this, right? When do your clients do tax planning? Are they calling you now in mid-July, or are they calling you in the second week of December?
Sometimes it's December 25th. And I tell people these things sell out in November, and even nothing's easy in the world anymore. Financial services, you want to put $1 in something, it looks like a settlement at a bank. I mean, we have all this paper, and most of our clients live it. Even though it's DocuSign, it's still, you're clicking that button 17 times, and everything has to be perfect. Any paperwork you see from our office has a bunch of eyes before you see it, after you see it. U.S. Energy has their own eyes on the document. So at any point, anyone in the reviewing can say this isn't right or this doesn't match, and it sends the whole thing back. So if you're interested in the 2-week, you need to, in the next couple of days, and then we have to start it so we can get in within the 2 weeks. But we're basing our math for our clients not on the incentive. We wanted the normal one. And the reason you get an incentive, and I know Fred knows this, you're taking the longest wait until you start getting money, because you get the money when they build it, and they build it when they raise the money. If you're the first dollar in, you're waiting the longest for your first check. And they're going to incentivize you for that because they need the money to go put the money out to work.
And let's hit on that. What are they going to get? They're going to get paid interest, right? Our corporate rate's a little over 4%. They're going to make that, right? So you're getting paid a pretty healthy cash equivalent, right? So think of it like a 5-6 month CD at about 4.5%. They'll get interest on that, and they'll also get better terms, which means their actual cash flow will be 7-8% higher than if they wait.
Sure.
Right. And all of this together, really what it does is, like any business, tax law says we have to close December 31st. Well, imagine raising $1 billion, right? And 900 million of that comes in the last 3 weeks of the year, right? Doesn't matter what business you're in, real estate, oil and gas, whatever your own business is. That's horrible for any business, right? You'd much rather have closer to a 12-month cycle to raise and deploy capital, secure assets, inventory, et cetera else, versus having to kind of have this little tight window. And so that's kind of the why, right? That's why we do that. But that's there for right now. It doesn't mean you can't access it in August and September. We'll have stuff out probably until the middle to late part of Q4 before we shut down everything for the year. But in general, that's the drilling fund. So again, drilling funds are there for ideally ordinary income. If you've got a higher income, you're getting crushed on tax. These are a great way to reduce that income. It works against most state level, not every state, but it works against a lot of SALT level state and local tax as well. And you also get tax benefits on the way out. So drilling funds are going to cash flow very quickly, very heavily, right? They're designed to get you out fast, and they're tax and cash flow, right? That's it. So that's ideally against ordinary income. You can really use it against any kind of tax, but income is where. On the other side, for capital gains, there's another structure that what are called opportunity zones that might be of interest, but that is specific to capital gains. So we separate the two, right? Because drilling funds are good at tackling ordinary income tax, but if you have a big exit or any kind of a gain, long-term, short-term, it doesn't matter, any kind of a taxable capital gain, an opportunity zone is a great vehicle to take that tax bill and turn it into a tax-free cash flow vehicle with a tax-free exit, right? So that could be something we hit on, Fred, before we kind of take it.
Yeah. So walk me through, let's say and it could be real estate. It's for anything. So you have a collector car. It just got recodified in the government. So now it's been expanded, which Fred's going to talk about. So let's pretend we sell something and there's $100,000 capital. Our accountant says we have $100,000 capital gain. I give you $100,000. What's that do for me?
So instead of paying your 20 or 30 grand, right? Because your cap gain tax are typically 20 to 30%. Even long-term cap gains, most people don't realize it, but it's not just 20%. You've got your 20, you've got your 3.8 to net investment tax, and you've got your state tax. A lot of states have, even like Washington, they don't have income tax, but they have state capital gains tax, right? So you got to add those up. So with that said, you can utilize that instead of having to pay 20 or 30 grand up there and having 70 or 80 left. You can put that 100K into an op zone and get now here's the downside. An op zone, you got to hold it 10 years, right? Tax losses, you got to be in it 10 years in a day, right? So I can't do anything about that. That's the law. But if you were able to do that, you can get some nice things in between, right? One, you can get your tax bill not just deferred, but you can get it reduced and potentially eliminated, right? So you don't have to pay that bill. We've got a mechanism that will pay that for you, right? That's part one. Part two is you get a tax-free use of that cash flow. So not every fund can say this, but our fund pays a 6% income. And because it's oil and gas, right, it ends up netting tax-free to you. So instead of paying your tax bill, now you get tax-free cash flow, right? That's parts 1 and 2. And the cherry on top, to me, is the back end, right? Because in that structure, you're just reinvesting. If we're seeing 30, 40, 50% cash flows, which is what we see in oil and gas, I'm only paying you 6. So that delta, everything over and above, is put back in the ground. Think of it like Fred, like your own business, right? I'm not sure your structure, but let's just say you're like a mini C Corp, right? Mm-hmm. Where you've got your G&A coming out, right? Every other dollar that you're making, you're putting back in the business. That's what this does. That's all it is. And the cool part is that because you have so much cash flow and these assets cash flow so heavily, you're reinvesting over 10 years, you're reinvesting that capital 2, 3, 4 times. And so now when you go to exit, if you put that 100,000 in, you're not looking at 100,000 on the way out. You're looking at 200,000, maybe up to 300,000. And it's not just that you're getting a lot more back out. Fred, what's the exit on the op zone?
All tax-free.
All tax-free.
All tax-free.
So your tax bill got wiped out. You got tax-free cash flow for a decade, and you doubled up or better with a full tax-free exit.
And I did an opportunity zone for myself. I didn't use oil and gas. I didn't know about it at the time. I probably would have done U.S. Energy. I did the traditional ground-up development. It pays nothing for years, where Fred's starting to pay fairly quickly. But I'm going to use it for college because the 100,000 is going to come back at more than that, all tax-free. And if kids don't need college or have spreadsheet or have a scholarship, I might buy a new Corvette or whatever.
There you go. Yeah,
see me in a new shiny car in 10 years. That's probably where it came from. So these are planning tools. These are unique tools. These are educational. The Opportunity Zone Fund is going to be open, so there's no rush with that.
Let me put on one thing, and I do have a piece. And so there's 2 things I'm going to send to Fred's office: the visuals, a deck to follow along for the discussion from today, and then the other, Fred, is and this is all client facing. It's going to be a link, and the link is to a recent webinar that we recorded. So the OBB, right? The One Big Beautiful Bill that just came out. There's a lot in there, right? We took a CPA that's probably one of the most nationally renowned CPAs And the head of US Energy kind of dissected this a little bit. So there's some cool content, but here's one thing I'll put in there. If you've got a cap gain or maybe a potential cap gain, right, in the next, say, several months, one thing, if it were me, that I would want to know is that ob zones, as great as they are, right? Again, completely it's that unlimited Roth IRA, right? You have this tax-free bucket where the IRS says, I don't care if you're worth 50 million bucks and you put 49 million into an ob zone, that's fine. I'm not saying you should do that, but I'm just saying you have this unlimited tax. So my point is that those are not here next year.
Gotcha.
Ob zones are sidelined in 2026. So even though they can go for the rest of this year, just know that if you have an upcoming gain you're anticipating with something, you're not going to have that lever to pull next year in 26. Now they come back in 27. The 2.0 version of the tax law resets in 27, but they go away next year.
Gotcha. And it's good to know. So last question, and kind of as you know, creative is the name of our company. Can your solutions help with a Roth conversion type idea? I got 500,000 in an IRA. I know when I take it out, it's going to be earned income. Right. If I take 100,000 out, it's 100,000 of earned income. What if I did this with you? What if I take the 100,000 of that as earned income, and that becomes like, does that make sense to investors, or is that a little bit too much?
It's a big part of what we do. We have a share class within the design of our drilling funds for this exact maneuver. Okay. So here's one, I guess, closing thought in a fun way that these things work. In our industry, we are and it's all securities law. We don't have a room full of CFAs trying to come up with a number. We are required to heavily suppress valuations. It's just the law, right? We can show you why. What does this mean in English, right? To your point, you have $100,000 in an IRA. You probably want to convert that to a Roth. We all want to, right? There's not one person that has qualified dollars that does not want to do it. It's just, I want to kick the can, right? I pay too much tax as it is. I don't care what it grows to. I'm not paying more. Well, what if we can have your 100K reflect a heavily suppressed value, 40, 50 grand within a few months, right? So in other words, last year, we're about to post these values. When this happened, a client put 100,000 in. That value that showed up at Schwab, NFS, wherever you custody assets, came in at about 38 grand. So it went down by 62%. It has nothing to do with your 100,000 to 100,000. It has nothing to do with that. But the paper value for a short window shows up heavily discounted in oil and gas. So you can probably see where we're going with this, Fred. What did everybody do to their 100K that is now 38, right?
That's what
you do. Roth conversions. The IRS just said, I'll pay 2/3 of the tax bill. You're like, thank you, right? We'll convert to our. So what's fun is that there's some really fun tax planning concepts behind the scenes for those that have a lot and qualified, that are sick of the tax game, that don't want to deal with RMDs, right? That want to stick it to the tax man. They can do that in a fun way with these kinds of structures.
Perfect. Well, thank you. I know we went a little over the half hour, but you get two Freds together. That's what you get. Yeah. So, Fred, I want to thank you. Thank you for your strategic partnership with us. Hope to have you back. Hope to get questions from our clients, from our friends. If this could help, we're happy to look at it, and we'll be the first ones to say, hey, this isn't your year for the oil and gas is not going away. The op zone is. So, I know we have friends and clients that are potential future liquidation. So we need to just land the plane at the runway that's open, and there's going to be something. I don't think opportunity zones are going to go away altogether, only because it's bipartisan. It incentivizes investment that the government doesn't have for an area, that the governor wants more development, which is a win for people that need a place to work and a place to shop, and investors who have capital gains outside of real estate. There's a ton of options in real estate. This is outside of real estate. So even guys that know real estate well, they should not have every investment they have in a different package of the same asset class. So having an oil and gas op zone, if you're heavy into real estate versus a real estate based op zone, that's just common sense. And US Energy is our tool for that, for obvious reasons, being 40 years old. I mean, that right there, that filters a lot of the players that we would look at, and their consistent returns and the blending of their they're not just buying one thing, hoping it works. So it's very repeatable, which is it's more of a flywheel concept for us is, has anything changed on US Energy's numbers this year versus last year? Fred is very transparent. When there are changes, they let us know. They have to, and that's part. No one wants to be surprised by anything, because the world will surprise us outside of this conversation. So at least the stuff we can control, we don't want to surprise each other. So Fred, thank you very much. If you're listening to this live, shoot me an email. I'm not going to just send a deck to everybody because I don't want to fill your inbox. But if you're interested, send an email to the office, call whatever you need to do. We'll get you the deck. We'll get you all the information Fred talked about. Eventually, this video will be on our YouTube channel. We have a couple there. I'd like to have an entire library that kind of matches the conversations that I write about in Forbes. So if you want to read something or send someone something, if you go to Forbes.com, put my last name and put taxes or oil and gas. I did an article on oil and gas. I did not sell U.S. energy. I did not sell anything because it's just here's the landscape. Here's the industry. So Fred, you have my permission to use that article and say, hey, this guy uses us. This guy, is a partner of ours. It's out there. It's public. It's on Forbes.com. No charge. I'll give it to you for free. And the articles for everybody are for free, although they pay me. Readers don't have to pay anything. I think you get 5 or 6 a week or a month to look at for free. So there's a lot of information out there. Most of it is accurate, but this is an accredited investment. So there's not like a ton of public information. And that's really why I'm writing the Forbes article, is what we're doing isn't new. It's just new to the people. This stuff has been around for decades, if not, multiple decades. Fred, thank you very much for your time. And thank you everyone who's on the phone or in the video, and I'll catch you next time. Take care, everybody.
Take care.